Hello, Smart Money Tree podcast listeners. Welcome to this week's show. My name is Kirk and I'll be your host. And today I'm joined with my good friend Doug Heagren. Hey, Doug.
Hey, Kirk. Good morning to you. Good afternoon, wherever you may be. Today I'm celebrating a very important event in world history. This day of January 5th, 1975. A very important thing happened today.
What happened, Doug?
I was born.
Oh, well, that is an important day. Thank
Yeah,
you for disclosing your confidential data that now you will be used to pilfer your financials in some other way.
that's okay. My social security number is and my date of birth are already on every list out there. I've been filing. So when you file your taxes, if there's any concerns over individual personal information loss, they will they basically give you a PIN number every year to file it. So I've been getting a PIN number for my tax returns for probably the past 8 to 10 years, ever since somebody randomly in Texas filed a tax return under my name trying to claim a refund in Texas. I got a letter from the IRS telling me, 1 year is like, have you lived in Texas? This was ironically before I ended up living in Texas for about 4 years. I'm like, no, I've never lived in Texas. Is this your address? No. Like, well, you just filed a tax return. I'm like, okay, now. So, hey, it's already out there. There's nothing more I can do about it.
You and the Underhills. Just put it on the Underhills bill.
That's right.
All right.
Speaking of Underhill, isn't that House of Cards? That's a whole different conversation.
All right, we're not going to get into the politics today. Today is Friday. It's the 5th, January 5th, and it is a new year. So happy New Year to everybody. Oddly enough, the Epstein document dump came out today. I think it was today or some point today, and the memes have been ruthless. And we're not going to get into that because I'm just going to. There's nowhere we can go where that's a good thing. So we're just going to just say it and move on. But
let's just say this, whatever part of the spectrum you're on, if you want good entertainment, go find it yourself because there's a lot out there.
There's some really entertaining memes. That's all I'm going to say. So anyway, we're getting into the new year here. And what's been interesting to me is so far we had last year where the markets pretty much started at a low point and went up. Then they went down, they went up, they went down, and then they went up again. And they ended up at not the all-time highs, but just a shave off all-time highs. And this year started off with a thud, not a bang. And so I want to talk about that a little bit because I think, when people tend to get caught up in the narrative in the media. We talk about this a lot in the show, and I'm going to tell a quick story. And then we're going to get into this. But the story is I was on a cruise 15 years ago, maybe. Somewhere around 15, maybe, yeah, somewhere around 15, 18 years ago. I was on a cruise, a Baltic Sea cruise. Anyway, I was sitting at a dinner table at a dinner with this couple from the UK. Great couple, had a great conversation. Maybe it was earlier than that because I remember having a conversation. No, it was earlier than that because Bush was president. So it might have been 07 or something like that. And so I was talking to this couple, and I was just curious. I'm always curious and just asking people questions. And I said, look, so what do you think of Americans? Our media is telling us that everyone hates Americans, right? And they just started laughing. They're like, you silly Americans. Like, we don't hate America. We love America. We love the people. We love the culture. We love everything about it. We just don't like your president very much. I was like, okay, that's fair. It was Bush, it was a war in Iraq and all that. And like, okay, I get it, right? He's an unlikable guy to some people. And I was like, yeah, because our media keeps telling us this. And they start laughing. They're like, you guys are so funny. Like, everyone in the world knows their news is propaganda. Everyone, every country, UK, all developed countries around the world, they know their media is propaganda. But for some reason, you Americans think that your media is not. And I was like, okay, that's also a fair statement, right? I hadn't thought of it that way, but I'm like, yeah, I guess that's truth. And they're like, yeah, like, you guys, it's propaganda. We can see it's propaganda, but you guys somehow can't. You have this bubble on your head where you can't see past. You're like, no, these people are saying what I want to hear. It's true the world around, okay? Now, I use that as an example to start off because at the end of the year, if you'll notice, and I want each one of you as a New Year's resolution, I want you to do this as an exercise as much as possible. Try to be mindful. Try to step outside yourself a little bit and try to be mindful of what you're hearing as a narrative. Now, I'm going to replay 2023 narratives a little bit. I'm not going to go into bullet points, but I'm just going to tell you what I observed. Now, starting October of 22, things were still bad. You know, the market was still low. It'd come up a bit, but the narrative was still negative, and the market started going up and going up. And then once it got past the point of desperation, where it's like, oh well, maybe things are correcting, the media all of a sudden is like, hey, everything's getting better. But when you get towards the end of the year, when you get to, I think it was August, when the market started to drop, the world was ending. Starting in August till October, the world was ending. This is what you heard in the media, right? Financial media, Wall Street Journal, everywhere. Like, I'm not characterizing one as being bad and one's being good. I'm saying everyone had the same narrative because they get their information from the same place. So they had the same narrative. And their narrative was, oh, the world's going to end. All these things are bad and, whatever. And so the stock market dropped significantly. And then mid-October, I think it was mid-October, the market started to crank. All of a sudden, one day, the market jumped. All of a sudden, everything was better, right? The news is like, hey, everything's great. It's going to go up. We're going to have a Santa Claus rally. Everything's golden, nothing to see here kind of narrative, right? And we had that until the end of the year. If you were paying attention to anything that was coming out, it was all positive, 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 positive. Look at all this great stuff that happened. Santa Claus rally, it's going to be great. Next year is going to be awesome. It was nothing but positive news. Whereas only a few weeks prior to the day was all negative. The world's going to end. All of a sudden, everything's great. Okay, so if you think about it, there's no real contradictory opinions in the media. It's not like one person saying, oh, it's going to be great, another person saying, oh, it's going to be terrible. They don't want to hear that, right? If you go on CNBC, they tell you what you want to say. Like, you're like, oh, I'm going to say this. Now you shouldn't say that. You should say this. This is what I've heard from other people, by the way. So the narrative tends to be uniform in what you're hearing from people. And of course, they want to sell newspapers or eyeballs or whatever. But understand that this is going on because this is going to dictate your behavior. If you're getting beaten up with positive, 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 you're going to buy. If you're beaten up with negative, 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 you're thinking, oh, I got to sell, I got to dump everything. You don't want to do that. You don't want the media to dictate your behavior. And they do. They influence it. I know what's going on. It influences me. I'm thinking, oh, maybe I should jump in. Maybe there's some opportunity here. This is what's going on in my head. I know it. I know what's going on, and it still impacts me. And so I want everybody to think about this because it was, December 31st or December 29th, I think was the last day. December 29th, and it was like, hey, Santa Claus rally. And it wasn't a Santa Claus rally. Like everyone thought, oh, it's going to be great. Santa Claus rally. Everyone's going to make lots of money. And it ended up being bad news. There was no Santa Claus rally this year, which if you look at statistics will dictate the following year is probably not going to be good. Now, I think some of this is bunk because so what? The Santa Claus rally, it's meaningless. It's just like 7 days or so, or maybe it's 8 days. 7 to 9 days, somewhere in there, where technically the Santa Claus rally, it encompasses January 2nd or 3rd or something like that. So there's a handful of days in there where it's like, oh, if it's good here, the next year is going to be 80% chance the next year is going to be positive. Okay, well, that's great data, but how does that tie into reality? It doesn't. It's just statistical data that other people look at, and then they say, oh, well, this is meaningful, so I'm going to do it. Well, if enough people do it, it tends to be meaningful, right? It's the self-fulfilling prophecy, if you will. It's like saying, oh, there's going to be inflation. Well, there's inflation, I should spend my money, right? Or I should invest it, or I should do something. There's deflation, I shouldn't spend my money, I should keep in cash. So if I decide there's deflation, I'm Jay Powell, and I say there's going to be deflation, what are people going to do? They're going to hoard cash. Well, if they hoard cash, what happens? Asset prices go down. So more people hoard cash. If asset prices go down, if the economy goes down, people stop spending, it means earnings go down. Well, if earnings go down, then fewer people spend, right? And companies spend less, which causes a negative reinforcement loop down. So the negative reinforcement causes more negative reinforcement, which is a spiral. It's a self-reinforcing circle. So the self-fulfilling prophecy is when you tell somebody something and then they do it. My point is an 80% chance of success in a Santa Claus rally. A positive Santa Claus rally means 80% chance of success in the future year. People are looking at that and saying, oh, we should do this. So there is some fact to that, based on human psychology and statistics. It's not it has no correlation. I'm sorry, it has no causation. Well, actually, even I just being a hypocrite here. There's very little causation. The causation comes from the self-reinforcement loop. It has nothing to do with like, oh, well, these last few days more people bought and equals more revenue. That's not causative in real life. It's only causative in prices. So I know I'm kind of going off the rain here, but let me bring it back. So the point is that we've been hearing a lot of positive, 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 and as of January 2nd, the market went down, and there was some Apple downgrade by one of the investment banks, and there's nothing but like bad news coming out, like, oh, this is going to be terrible. You're going to have a recession, bad news. So just be mindful that this is pushing the direction of markets when you hear this nonstop. And stocks haven't changed in the last month. Earnings haven't changed all that much. And it certainly hasn't changed in the last week. But yet the narrative is very different in the last week. What's changed in reality? Not much. A little has changed. We're going to talk about the container shipping index and a few other things. But generally speaking, it hasn't changed that much, right? And so if one Fed governor comes out and says one thing and the other Fed governor comes out and says the opposite, that's going to move markets. And you have to wonder, are they saying it to move markets deliberately? Makes me wonder. So anyway, going back to the narratives, just be mindful this year of the narrative you're being given and how that's impacting your thinking. It's really hard. It's the concept of influence and persuasion is based on human nature, psychology. And if you know, and I'll give you this simple principle. If somebody is trying to manipulate you and you're aware and they're good at it and you're aware of it, it will still influence you. You can know it's happening and you're still going to feel like, crap, I want to do that thing. You can't escape it. You can't be above it. It's your human nature. I feel it happening and I know it's happening and I can forcefully say no. But if I wasn't aware of it, it would easily influence me. Some people are that good where they will influence you and you'll know it and it'll still influence you. So just be aware that's going on this year. You're going to see a lot of that. We saw a lot of back and forth over the last 3 years, and you're going to continue to see, in my opinion, you're going to see more volatility this year and continuing. We might see a big drop. I don't know. I can't tell the future. I suspect we might. Which we're going to talk about some of the charts, but it's something to be aware of this year because the volatility is going to cause you to make stupid decisions because you're going to go with the flow, and you don't want to go with the flow. You want to make decisions mindfully based on a plan, and you want to have an exit based on a plan, not based on what they're saying on TV, because what they're saying on TV is pointless and baseless, right? They don't know Apple's earnings any better than I do unless the CEO told them what the earnings are. They don't know any better than I do. So just be mindful of that. Try to step outside how you're being pushed and influenced, and try to be mindful of it. And I think you'll find that when you're aware of it, it helps you combat it much more easily.
Did you miss your opportunity to get PPP money during COVID? Are you waiting for our president to forgive your student loans? Are you excited about helicopter money? Me too. If you want free money, look no further. I'm giving away free money this week on our show. All I ask is 5 or 10 minutes of your time. I'm so excited to give you free money, I can hardly contain myself. Take advantage of me and my excitement to get your free money. Go to www.moneytreepodcast.com/free money. Follow the instructions today and get your free money.
So we got a lot to cover this week. Doug, where do you want to start?
I think one of the things that I want to take a look at here is, and I think it's a good place for us to kind of just get a segue on what you were just talking about is, kind of just some of the rhetoric that we heard going out of last year. I mean, one of the things that I think we've talked a little bit about is how many rate cuts the market felt was going to be occurring this year. And of course, we talked about this previously, that the rate cut that they were priced in something like, I believe, 8 rate cuts in 2024, that there was even a 10% chance. of 8 rate cuts into 2024, less than 1% chance of 9 rate cuts. So, most people are, that were involved in these probabilities, we're kind of thinking somewhere now around 7 interest rate cuts into 2024. But on the extreme end, I mean, 9 plus. Now, again, this goes into that bullish rhetoric that we were kind of seeing as we kind of went. I mean, it's kind of actually not bullish. I mean, bearish. Obviously, rate cuts are bearish. That there's been so much of this priced in that there's they can't keep raising rates. Inflation was fixed. I mean, it's bullish and bearish in 2 different ways. It's basically saying that they've tempered down everything. Inflation's down. Now we got because of fears of potentially overstraining this, that leads to recession. Therefore, you got to have rate cuts in order to stimulate the economy. But that wasn't really reflective. It's interesting because that's, in a way, we've seen this for the last 20 years for those people that have been investing in this. You see this when you look at 2008 and really the excessive amount of Keynesian level money injection and fiscal, and policy that has occurred since the mid 2000s, is that whenever things get a little bit concerning, inject some QE, or come up with the bank term lending program, or do all of these things to inject capital to solve the problem. This goes back to the list we were looking at over some of the last couple conversations of the truths and the half and the untruths, right? Is that the government they can't sustain that pain. If it gets uncomfortable, they're going to capitulate. Now you take a look at when things are getting bearish, they'll do rate cuts or they'll inject capital to do QE. When things are too good, then they will pull things away and they'll raise those rates to slow them down. And that we've seen a tremendous amount of Keynesian level policy over the last basically close to 20 years. Well, the market started to run significantly, starting, as you talked about, kind of at the bottom of October into the end of the year, and especially in that last Santa Claus rally, which again, Santa Claus has gone back to his fortress at the the North Pole, so that rally is clearly over. But what's ironic about it is that the market was pricing in 7 to 9 rate cuts, thinking that's obviously a negative. The government's going to have to cut these rates, or at least cut them based off of the fact that we got to the point where the government, where the Fed wanted to be. But when you run the stock market up like that, that's going to be counterintuitive to the philosophy of the Fed that was trying to temper down this excessive heated market. And what does that lead to? What did it lead to? Well, it was always in a disconnect. We talked about this before. The Fed had never hinted that they were ever going to do 7 to 9 rate cuts. Now, we did talk about the fact that they started to capitulate, which helped to drive this, that some of the rhetoric coming out of the Fed was starting to say, look, yeah, we might do some rate cuts next year. Well, all of a sudden, in like a 2-week period, we've gone from extreme levels of expected rate cuts to all of a sudden a fear that they're not going to hit that number of rate cuts. Oh my gosh, paint me a gasp, Kirk. Wow, it's not going to hit 7 to 9. No kidding. We've been talking about this for 2 years. The Fed has been very transparent about what they want to do. Okay, so we said this last quarter, which is 5 days ago. The Fed was never talking about 7 to 9. So why is the market continuing to create these extremes that are different than what we've been continuing to be told? Now, again, is there a question that Powell has all of a sudden decided instead of being Volcker, he wants to be Burns? Yeah, there was some hint of that because, again, the Fed does not like to feel pain, and they can't handle it, and they've shown a tendency to react, and there was maybe some reaction there. But now we're starting out the new year with a reality. If the market was pricing in all these rate cuts, which were never being articulated, and now those rate cuts are no longer being felt that they're going to be attainable, yeah, market's pulling back on that because maybe they priced in some ridiculousness that wasn't necessarily ever constructed with a foundation to be there. Now, what are some other things that are going on? First of all, the market heated up. If the market heats up, that's not going to promote a Fed rate cut. The other thing is inflation did come back down, but there was some data and some charts that we've looked at and talked about last quarter that said, inflation could very much take off again going back into 2024. Well, you just talked about that chart. If you talked about that one chart, we just saw data. And again, like you said, Kirk, nobody has information on what Apple's numbers are going to be, right? And so none of this stuff is actually being priced in right now to a lot of the reason that the market is pulled back for the first 5 days of the year. Some of that is just blowing off, it could be just blowing off froth. But as some of these things start to hit, you might start seeing they've either priced in some of this information back into the market. I mean, I said this on another communication that we had. In a 5-day to 10-day period, we went on the fear versus greed index from extreme greed to extreme fear. No in between. No, it's not like a gas tank that trickles down. It literally went empty in a 5 to 10-day period. It's crazy the amount of the movement that's going. Well, right now, and again, this just came out yesterday. So this is not priced into what's going on in the market. But the World Container Index just increased 61% to $2,670 per 40-foot container this week. If you look at that chart and you look at what the pricing was doing as it was dipping down. So looking at that chart, we basically went from around January 2023, it was looking at cost of around $2,200 per 40-foot container. And that just continued to dip down and to a low of about $1,500 that hit in around early July of last year. And then it went back up a little bit, to about 17, about maybe 1900. And then it came back down to under 1,500, probably around $1,400 to ship that. Just since looks like December 31st, it started to dip back up in December through December, but really just back to the 1,500 range. Since December 31st, I mean, we're only 5 days in, Kirk, and it skyrocketed from $1,500 to $2,670. Now, what is inflation? Inflation is the expense of goods. It's the expense of services. Part of that expense is getting them to you. And we just looked at, if you take and jack up about $1,000 increase for every 40-foot container this week, that comes through this week, don't just sit there and anticipate that that's just going to be an anomaly. That gets passed through in pricing. So are we starting to see at least one indicator of a potential shift of lower inflation back to higher inflation? Hard to say. It's just one indicator. But that is absolutely a significant level of cost that gets passed into what you're going to end up getting in both wholesale and retail pricing. And by the way, folks, that's inflation. And if we want to talk about inflation, that is an inflationary cost of container shipping that is roughly looking at almost an 80%, or no, what they said, 61% price increase. And now that's just this week. So if you count that from the bottom in November, we're looking at almost a 70% increase in shipping costs over a 1 month period. That's extreme.
Yeah, and I think you bring up a lot of great points, Doug, and I'm going to bring up I want to start this with some chart crimes, and then I'm going to go into some other areas because I think there's some really interesting stuff that I've been seeing, and I want to use some of this as education. So we talked about this last time, this chart, and I bring this up for two reasons. One is notice there's really 3 months or 4 months in there, right, or 5 months. That's correlation over a very short period of time, right? And so that correlation, I would say, it's like correlating a daily stock price. The shorter you get, the less relevant it is. The longer you get, the more relevant it is. So I want to point this out just on the timing. I do want to point out, though, that there actually is a strong correlation over the last few years between bonds and the S&P 500. So there is actually a really strong correlation, and this is something to note. As long as they're positively correlated, then we're in a different paradigm. As soon as they become negatively correlated, then we're back to the old paradigm. So just something to keep in mind. But I did want to point that out because I think we talked about it last time, but that plays into the next one here, which I want to point out a few, and this is not a chart crime, but I did want to bring it up. Oh, this I'll put as a chart crime. Here we go. Here's chart crime number 2. Inflation is similar to the 1970s. And what they're doing here is they're comparing, in the gray, they're comparing 1966 to 83, which actually looks very similar to the lumber prices back in COVID. Lumber prices went up, then they went down back to where they started, then they went up even higher, then down, and then way up, and then down even lower. So there's actually, they ought to do a correlation to lumber prices. It looks very similar. But what they decided to do here is they've decided to correlate it to the present. So 2013 to the present. They're saying, oh, look at the inflation. Well, I don't know. That chart doesn't look all that correlated. I just see a big bump, and that was about as correlated as it gets. I'm not saying that this isn't going to be the path, because as we've talked about in the show, I do think that we're going to see a similar path with inflation. We saw the spike. It comes back down. Everything's clear. All's good here. You can go home, go about your business. And then inflation spikes up again. We don't know how or why, although right now, as Doug pointed out with the shipping index, it appears it might be from the shipping index and the I don't know what you want to call them. It's not a war yet. Skirmishes going on in the shipping channels over the Middle East, where I think it was the Houthi rebels are shooting rockets at shipping containers, and now there's U.S. destroyers and other countries bringing their warships over there to defend the shipping lanes. Which, if you really think about it, when you're the world's reserve currency, that's your job, is to police the seas, to basically police the shipping lanes, to make sure that pirates aren't stealing stuff that's going to Walmart. Although I don't know how many ugly Christmas sweaters I really need if I'm robbing a shipping container. But anyway, that's neither here nor there. But I do want to point out that is seemed to be that is going to be happening more and more. So that correlation that I just pointed out, I think is, albeit it might end up panning out, I think it's probably for different reasons. I think that what they did is they just tried to make it fit. They probably could have just cut off the back end and said, oh, look, it's a bump, and that's it. So I think that to me, in my mind, is a chart crime, and you shouldn't look at that stuff. Here's another one that I found interesting, and this has no relevance to anything, by the way. This is when you take all the odd days and their performance, and the even days, you take their performance. So basically, you buy it in the odd days of the month, and you sell it in the even. So the even days are in the last. I don't know what I actually don't know the numbers, but maybe this is just number of units. So if you look at the units from the start to the finish, the even days went from 0 up to looks like about 90,000. And if you look at the odd days, it's basically stayed at 0. So if you just bought in the even days and sold in the odd days, you would have made a lot of money. This has no relevance to anything. And but I just thought it was interesting when I see this stuff and say, wow, that's an interesting data point. And what's more interesting is somebody wasted their time in the day to even bother to do that. But that's a different story altogether. So I want to point something out about gold, okay? And I'm going to use this as an example. Not that you should go out and buy gold or crypto. Not saying you should go out and buy crypto. But there's something about investing that you should know. And this is actually a good rule of thumb that you can pay attention to for your investing. If you're a long-term investor, you can pretty much ignore this. If you're more of a shorter term momentum investor or whatnot, it actually is relevant. So think of it this way. We saw, 2 years ago, we saw crypto crash and burn, right? Like Bitcoin was down like 70% or 78% or some crazy number. It was down a lot. And yet last year it was up a few 100%. How many people were talking about that? Not that many. I mean, some were, but not many. And, if I look at it, it's not at all-time highs, but heck, it's a hell of a lot closer than it was the year before. And, we're probably, we're not at all-time. Anyway, the real crypto price versus what I'm looking at are different. But the point is we've made a lot of headway getting halfway back. How many people are actually talking about that? This is a bullish sign. And remove the fact that I'm talking about Bitcoin, because this is not about Bitcoin. This is about using Bitcoin as an example. I'm going to use gold as an example too. So if you look at what happened, it got crushed And so, by the way, so did technology. The Magnificent Seven also, the whole NASDAQ got crushed in 2022. Magnificent Seven actually took the same path. They also, boom, I mean, it was like 100, 150% for some of the Magnificent Seven. Can you imagine some of the largest companies in the world going up 100% plus in a year? Crazy, but it happened. So I point this out because people were talking about those. And I think at this point, those are overpriced because everyone's talking about them. But if you look at crypto and gold, and you look at gold, how many people have heard that gold is close to or exceeded all-time highs for the gold price? How many people have told you that? Not many, I wager. And the fact that no one is talking about gold making all-time price highs is something you should pay attention to. It's not the fact that it's gold, and people who listen to this program know I love gold, but I'm watching it, so I'm mindful of what's going on. People are not talking about gold, and it's making all-time highs. It should be front page on every newspaper, gold all-time highs. Why is it not front page? Human psychology. It's made highs, and then, well, not all-time highs, but it made recent highs, and then it's kind of went sideways for a long period of time. People have ignored it because it's not moving. And now it's made all-time highs. Now it's still within the range. So I'd argue that it's not really breaking out. It's not really exciting at the moment, but it's technically exceeded the all-time highs. And if that's the case, you should be watching it because no one else is watching it. And when something is making all-time highs and no one's talking about it, you should pay attention. Because what it means is, think about it this way. Let's just break buying of stocks to the bare essentials. There's 10 people in a room, and only those 10 people can invest in a stock, right? So if one invests in the stock, it hits a certain price, then another buys it, and it maybe moves the price up. When all 10 have bought it, the price is going to stop going up because everyone already owns it. You can't buy anymore, or they won't buy anymore, or whatever. There's no more money to put into the stock. The stocks go up because someone is willing to pay more than somebody is willing to sell, right? So if I'm selling my house, I'm like, I don't want to sell my house, but if you give me $10 million, I'll sell it. Well, it might be worth $1 million. So my price is $10 million. Well, if somebody pays it, sure, I'll move. I'll go buy another one, which means I'm probably not going to sell it, right? Because nobody's going to do that. But at some level, people are like, I'm not buying anymore because I'm not paying you $10 million. And you're not willing to sell it, so it means the price stops moving. Then the only place it can go is down, because then at some point people are like, well, I need cash to buy Christmas gifts or whatever. So they start selling some shares, and then the price drops, and then it keeps dropping. So prices move as long as there's more people to buy. When you run out of buyers, then the stocks usually peak out, and then they start to go down. So take that psychology and build that into gold. How many people are talking about it? Very few. We talked about it on a prior show here. How many advisors, what percentage of advisors own gold? It's like 30%. I have to go back to the chart here. It's like 30% of advisors own gold. What percentage? Approximately 1%. There's almost no money from the institutional community or advisors in gold.
Now, 71% of advisors have less than 1% exposure to gold.
There we go. Yeah. Thanks, Doug.
Yeah.
I can't
no problem.
find it in all my
and the other thing I wanted to just add on, because I think you were looking for that one too. Stock prices are at record highs in fiat currency, and measured against gold, real money stock returns are just average. The real growth peak was 2000. Since then, increase in stock values are more due to currency devaluation. That's opinion. But the point is, stock prices in gold have actually, there's been a significant significant impact of the value of gold against stocks since probably about 2013. So when you talk about those highs, it's back to like 1967 ranges, not quite where it was in 2000, but it has been steadily trickling up here for about the past 8 to 10 years.
Yeah, and look at this. I mean, for those of you who are watching this, look at this. 0% of advisors own 10% or more of gold. Well, obviously, they didn't interview everybody because I know there's a bunch of people who do. But 5 to 10%, only 2% of advisors have their clients 5 to 10% in gold. 1 to 5% is 27, and 71% have 0 to 1%. That's crazy. That means if you look at the amount of money that could go into gold, it's very small. Now, countries Like sovereign countries are buying gold, especially Russia and China and a few others are buying gold hand over fist. And the U.S., I don't know what the U.S. is doing. Their numbers haven't changed in decades. But the point is, if you look at this, you'd say there's not a lot of money going into gold, which means if we're making all-time highs and it starts to climb, an enormous amount of money is going to go in. What happens when there's a lot of buyers? It means the price goes up. So as we said earlier in the show, a higher price leads to a higher price, as long as there's more buyers. When you run out of buyers, it tends to go the other way. But as long as there's more buyers, it's like a short squeeze, right? A short squeeze is effectively, and you remember the book, what was it called, Dumb Money, or the movie Dumb Money that came out? It basically is the meme stock craze. Like they basically took, I think it was Melvin Capital, and caused them to go bankrupt because they basically took their short squeeze and they had all these retail buyers pour money into these stocks that effectively were worthless. But
AMC, GameStop, two of the big ones. A lot of people, Stonks. That's where the nickname Stonks came from. Yep, to the moon.
Yeah, and so it pushed these stock prices up because not only were they buying, but these short sellers eventually had to cover. And to cover a short sell, it means you have to buy. So everyone was buying and no one was selling, which is why they went from like $10 up to a few $100. And that is what caused that, because everyone was buying and no one was selling, which means buy, I'll take any price, and it keep pushing the stock price. So gold is the same way. If enough people want to buy and no one wants to sell, it's going to push the stock price up. So be aware, and I'm not saying gold's going to take off from here. I love gold for a portion of the portfolio. I think fewer people own it than should. It's a good hedge against inflation. It's been acting well, not as well as it should be, but it's been acting well in terms of inflation. So I do expect it to continue to go up as long as we have higher inflation. I expect gold to have a positive movement up. But that's my opinion. I don't know. I don't know the future, but I suspect that's the case. So we have some portion of clients into gold. And so if it starts to take off and actually move higher, you might look at adding some to your portfolios. You might look at increasing your percentage if you have it. I'm not saying put all your money in there. That would be dumb. Don't ever do that. Don't put all your money into anything. But make sure that you have a percentage, because it is moving in a positive direction. And so you can look at any investment the same way, right? Like you look at the Magnificent Seven. They took off because people were like, hey, they're going up, so let's buy it. And same thing with crypto and other things. So it's just a framework to keep in mind. When things are taking off of the bottom, it takes a while. You're like, I don't know, I'm not sure if it's bottomed yet. And it takes a while for people to buy into it. But when stocks are at all-time high and no one's talking about it, that's a bullish sign, right? It's the same thing we talked about in the show earlier, where if a stock is really going high and it's taken off, it's at all-time highs, and it comes out with great earnings, and then the stock price declines, that's a bad sign. That means that all the good news have been priced in and the stock's probably going to go down. Just like at the bottom, if the stock's at the bottom and it has really terrible earnings come out and the stock price jumps, that's a good sign. It means all the bad news has been priced in. So these are psychological factors you should be aware of in the market if you're looking to have better performance. You should be mindful of these things, because these things are going to help your portfolio. One more point I want to make, and then I'm going to give it back to you, Doug. We got so many charts here. I'm getting lost in them all. So where is it? Well, why don't you take it, Doug, and I'll wrap it up, because I got a few things I got to find, and we got a lot of charts here.
Well, I'm gonna make you look at one real quickly here, Kirk, and I just posted this for you because you were talking about, and since we brought this up a couple times, the correlation over the last extended period of time, going back a couple years. I put two. I know sometimes it's hard to read there, but what I did is I looked at a 2-year and a 3-year. So going back to January 5th, 2021 and January 5th, 2022. Basically, and what you can see here, and I think the 3 years, 3 years is a good one on this, because what you start to see is typically and historically, we will find that there is going to be what's known as negative correlation between equities and bonds. That's why people have historically used them. But what Kirk was talking about earlier is that there has been an extended period of time where there has been some strangely unusual. When I say strangely unusual, not that this is a sign of things to come, but historically, this does not occur for an extended period of time where bonds and equities are effectively flowing in sync. And again, I'll remind people, what does correlation mean? Correlation means that they will tend to overperform simultaneously or underperform simultaneously. They're linked together, where it doesn't seem to be an independent path, where a reverse correlation means that you would expect something to underperform when something else overperforms. That's historically the case. So we go back to January 2021 at the beginning of the chart, you'll notice that for the most part, there's almost a non-correlation going on. The AGG, which is one ETF out there, I'm not recommending anything, but one ETF that tracks aggregate bonds, kind of flat, not really doing much, almost a non-correlation against the growth of the S&P 500. But when you start to get right to the beginning of 2022, they both decline. Now, this should not be a shock based, to anybody who's been listening to us, because again, we have said that while most market cycles and stock market cycles are tied to basically bullish or bearish predictions of the economy and the impact to companies and stocks, what happened starting the beginning of 2022 was a Fed-initiated impact on rates. And that, of course, has a direct mathematical impact to the effect of bonds, which would then, again, on the secondary market, you raise interest rates, you drive bond valuations down. Now, people don't want to trade them anymore. They don't want to have them because they feel basically whatever level of risk, whether it's big risk or low risk, depending on the quality of those bonds, they look at the interest rate they're going to get. They look at where they can get interest elsewhere. And does that interest give you more interest or equal interest with less risk? And if the Fed raises interest rates and you can effectively go get short-term bonds, well, those are going to be more or equal interest to long-term bonds with less risk. So basically that's what happened. Nobody wants them anymore because they can get the same interest rate. So when interest rates go up, you're going to see a decline in the interest that, no pun intended, or maybe pun intended, that you're going to have in trading those longer term bonds. So of course, 2022 came along, Fed raises interest rates, you see bonds go down. Well, that also has a correlated effect to the outlook of what, the market cycle, the economic cycle is going to be to businesses and companies. Because if companies are trying to get access to capital to grow their business, to pay off debts, to just function, and that interest is now more expensive, that's not good. That's not helpful. Just like it does in your household, it's going to impact cash flow businesses. And we've talked, several times about what we are starting to see in terms of rising potential bankruptcies, interest, debt, maintenance for companies. It's not great. Okay. So of course, that's why you'll see that while the bonds were going down, there's a correlation because the stocks ultimately also have a bearish outlook and go down. Now we started to see once again a slight normalization, and we started to see that normalization occur when we got into 2023. Looking at kind of bouncing around, correlated, and then we got to April. Stocks took off, and bonds dipped again. Okay, so there now began back to what we have traditionally known as a historic norm, which is reverse or negative correlation to each other. So as the stock market kind of went on a nice tear up until, roughly around July of last year, the S&P 500, treasuries declined. It's what we'd expect. However, once you got past July, all of a sudden we got back into correlation again, which is interesting. Again, a lot of this, and you have to keep in mind, a lot of this has to do with Fed policy or predictions on Fed policy, but treasuries began to dip, and so did the stock market. Between July and just after October, as Kirk already talked about, the market really took a pretty significant dive along the same time where treasuries would normally be historically viewed as a safe haven. Again, we were saying here, bonds are not always safe. Okay. But that negative correlation would be a safe haven to the dip in the, historically to the markets. It didn't happen. Bond values went down too. And as we got into the latter cycle from October on, we saw a lot of what we've talked about, this bullish outlook of, hey, we think the Fed's going to cut rates. Well, again, if the Fed cuts rates, mathematically, that is going to make short-term interest products become less desirable because as they're released by the Fed, they're going to be lower interest rates. It's going to affect bank interest and in money markets and things like that. So all of a sudden it's like, all right, these long-term treasuries or longer-term durations end up becoming exciting again because, when they're at 4.5 or 5 and short-term drums goes to 6 or 7, you're going to want to move out of those long terms to short term and get the 6 or 7. But if the 6 or 7 move on the short term moves back down to 4, well, that's going to generate interest again at a longer term holding at 5, 4.5 to 5%. So again, we saw treasuries rise at the same time the stock market did. Now, I want to explain it's understandable why we have seen a little bit more lockstep correlation between equities. And of course, again, the stock market rising on those interest rate cuts is bullish for stocks because it means companies get access to capital. They're going to be, things are going to be cheaper. It's also a sign, hey, maybe inflation is finally down. Yay, we're happy. Everything's good. So there is that correlation is explainable and it is understandable because of where it stems from, which is Fed and Federal Reserve interest rate policy. But that being said, going back 2+ years of pretty consistent correlation between treasuries and fixed income is extremely unusual. It's it's a weird correlation because it is not something that historically occurs while it can be explained. So where it's going to be really interesting is now 2024. Like Kirk said, if this continues, we have created at this time it's different. A paradigm shift that is going to change the way we're going to have to deal with how you manage portfolios. It's going to have to deal with how you prevent risk and volatility. We've talked about the 60-40 portfolio. Why was it created? It was created with this belief that during times of extreme volatility in stocks, that 40% would hold you up, not only because treasuries tend to be less volatile, but also because you're going to continue to get that nice steady Eddy income, 4 or 5% in there, which gives you more cash to buy more stocks when they dip and rebalance, etc. Well, if treasuries fall with equities, that 60-40 portfolio is crap. It's not going to do anything for you, right? So if you're still stuck in that kind of static model and we disconnect here, if we can get back to where treasury or bond, fixed income and equities go back to their historic reverse correlation, then let's just say it's still going to have some teeth. I still don't think the 60-40 is great because we've talked about how it tempers volatility. It doesn't temper risk, but volatility is most of the time correlated to what people think risk is, even though that's not the same. We've talked about that. But if they continue to be in lockstep for an extended period of time, it is going to be really important to revisit your allocations. Going back to that allocation conversation, the last thing I'll say was Kirk was talking about gold. If 70% of models have less than 1% allocation to gold, and I'm not telling you to run out and get gold, but if you're diversifying and you have less than 1 or 2% of anything, it's as good as not having it. It doesn't do you anything. If you're going to have something, you need to have it in, and there's been a tremendous number of white papers written over the last 15 years on this, that if you're going to allocate to something, having teeny tiny slices of things that are negative correlated or, is going to have very little impact in its ability to do what it needs, especially when some of the other things we've talked about has been that at times of the most dire news, a lot of things that are supposedly, especially when they're on the same side of the fence, like if they're either equities or fixed income, they tend to correlate when you don't want them to. They tend to fall similarly, but then they correlate or they don't correlate when it's time to rise. That becomes a real challenge. So you have to really understand what is truly correlated, what is not truly correlated, what actually works when risk starts to rear its head. But if you 1%, if I sit there and go, I'm going to add 1% fixed income or 1% gold to this, at the end of the day, it's not going to have any impact. You have to have enough of an allocation that when it has when it can have an impact, it has enough teeth to do so. And that's why most models out there, they just hold a lot of useless crap in small enough increments that it doesn't do anything. It's important to really have allocations built correctly to participate in what you need them to participate in during the times that that's needed.
Well, Doug, we got to wrap it up here. Where can people find more about you?
Sorry, I took the time on the rest of your charts. We'll get them next time. If you're FAFSA just started in December, finally opened up. It's time to file. As you can see here on my shirt, ProCollege Planners, my main focus is helping people get access to capital for one of the most expensive things in their life, especially you out there that might be in the same kind of similar age group. You now know mine, Gen X. Gen Xers are facing a wall of tuition costs, and we've got a lot of things we have to figure out for retirement. And if that sounds like you, lower that wall. Figure out how you're going to climb over that wall. And I'm not talking about flat earth here. We're not talking about the wall that's on the edge of the earth. We're talking about the wall of tuition, getting to your retirement. You can get over it, but you got to have the information. Start by getting free information. Go to our website, procollegeplanners.com, procollegeplanners.com. Very simple. Download our free money report for 5 minutes. It's going to tell you how much you can afford for college, give you some options on how much some colleges you're looking at cost, give you some other options. It's free. Yes. If you then need to have some questions and help, we're happy to help you with that. You can email us at info@procollegeplanners.com. But get the information so you can begin to make smart financial decisions. Because at the end of the day, you don't want to be stressed about this. You want to have your financial house in order and keep it that way forever.
Great. Well, thanks for coming on, Doug, and thanks for starting the year with us on such a good note. I'm going to touch on one or two quick things, and then we're going to wrap it up here. So first, I'm bringing up, this is the Druckenmiller Index. I've actually never heard of this, so this may be just some clown who made this up, or it may be a real thing. I know they've come up with a Buffett indicator, which people have known for a while. So it's possible. I just haven't heard of it, but I did want to point it out because I saw it floating around today. I was like, oh, isn't that interesting? And also wanted to point out one other quick thing, which, we don't talk a lot about in the show because I think, frankly, it's one of those indicators that's it's not a false indicator, but the importance of it in the short term is very low. And so a lot of people talk about the government debt. Oh, the government debt, it's really too high. Totally agree, right? We have way too much government debt, and eventually it's going to cause our ship to capsize, and it's going to be really, really ugly. But that could happen 20 or 30 years from now, right? And so I don't know when it's going to be an issue. I suspect it'll be in about 10 years is when it'll be an issue. But that's still another 10 years before it's an issue. But I did want to point this out because talked about a few weeks ago and actually got some hate mail because of this. Talked about Janet Yellen should be, burned at the stake and drawn in court in the public square for not refinancing all of our debt at the lowest rates that we've ever had in this country. And so now we've got this higher interest rates and we have this debt that's rolling over. And not only is it rolling over at a higher interest rate, but we're also adding on to that debt. So in the last 2 years, since 2022 and 23, the net interest cost of our national debt went up 38.5%. That means of the budget, of the amount of money that you pay in your taxes, 38.5% more is going towards interest on the national debt. So it was 476 billion, now it's 659 billion. And that number only probably will go higher because if they stop printing money, then we're going to have a real bad depression, and they know that. So I don't think this trend is going to change. And
can I add something really quickly? Very, very quickly on that?
Very quickly, Doug. We got to wrap it up here.
I was just going to say, we talked only a couple of weeks ago that the amount of interest payments equaled our military budget. It has now exceeded that. It's not in that extremely short period of time. And then for another time, another conversation for another day, you talk about rolling over debt. We have some interesting information about commercial debt and the way commercial debt is financed. That is going to be something that'll be a nice conversation for one of our other conversations.
All right. So, and then the last chart here is basically just kind of a public annual increase in U.S. public debt. It's just an interesting image to see. Obviously, COVID was a big spike, but what we're printing now for no reason. Things aren't bad, but yet we're still going into debt. So I just want to put all this into perspective. I think you hear about it in the news and they want to paint it as the end of the world. Well, it is at some point. It's just not today, and people paint it as if it's today. So I just wanted to point that out, just so people are aware that it's a growing problem. Not only is the debt growing, but also the interest that we're paying on the debt is growing, not only because of the size of the debt, but also the rate. And so if rates do spike higher, I think if we go any higher than we are now, we're in deep doo-doo, as they would say. So, but I want to wrap this up on a positive note. I think hopefully everybody had some good time this holiday season to spend with their family and time off to relax and get into what will most likely be a most interesting year. It started off interesting in the first few days, and I think that will continue. So happy holidays to everyone. Happy New Year. Hopefully you're starting the year off on a good foot, and we're going to help you throughout the year get through the volatility and the nonsense that will most likely be talked about because it's a presidential election year, and the nonsense has never really stopped. So we'll never have a shortage of that.
That's the show for this week. Thank you again for joining us on Money Tree Investing Podcast. My name's Kirk Chisholm, Wealth Manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on this show. You can also check out our show at Money Tree Investing Podcast. On our website, you'll have access to the show notes, resources, and the archive shows. Please remember to subscribe on our YouTube channel for immediate access to the new shows when they're released. When you subscribe to the show, it allows us to get access to some of the top minds of investing in personal finance. While you're here, please leave a comment and question if you want us to address it on the show. Have a great week ahead, and remember, no one will care about your money like you do, so invest in your life.